Okay, today we're talking about 2024 tax planning. And frankly, we're just going to show you the tax rates in 2024. But when we bring the word planning in, we help people, a lot of them turning 65, a lot of them in their 60s, a lot of them couples, many singles. And they're coming to us not to figure out what their taxes are in 2024, but they're coming to us to learn what decisions they can make right now and going forward to reduce their tax bill over time. I mean, that's the gist of it. So we've got the chart. You've seen this chart many times in our videos. We refer to this in doing our work for every client that we're preparing a financial plan for. It's just this stuff, and we don't have these numbers memorized, but pretty close. So I want to bring Tom on, and I want Tom to share with you, like, what's the reason behind going over this today, 2024 tax planning?
Yeah, I mean, we're doing this video because taxes are important. The more you pay in taxes, the less you get to keep. And so we want to help you at least understand how these brackets work, how they interact with each other, and how, with proactive planning, you can pay less in taxes, meaning you get to keep more of your money. I mean, that's ultimately the goal here. And so I want to bring up the show notes. These are at the link below on our video. They're also on our website under the show notes section. And today it's just the board. We didn't want to get it too complicated. And so we're going to spend some time first in this upper right-hand section of the board, the capital gains rate, because this is something that I find often is misunderstood, not just with consumers, not just by you, but a lot of times other advisors and other people you're getting information from don't fully understand how these capital gains works. And so if we look at the different brackets, I'll read the numbers, then I'll explain how to look at it. There's a 0% bracket for long-term capital gains. 0% tax rate is wonderful. If we can plan things in a way to not pay any tax, that is great. And so for a married couple, that's with the income, and I'll get back to how they define income in a second, but that's with the income of $0 to $94,050 for a married couple. For single, that's $0 to $47,000. The 15% capital gain rate, which is where a lot of people fall. For a married couple, it starts at 94,000, it goes to 583,000. For someone who's single, it's 47,000 to 518,000. As you can see, that's a very wide bracket to only pay 15% capital gains rate. If you look over, and we'll get to this in a second, but on the left side of the board, the ordinary income tax rate, you'll see that 15% is much lower than what some of the other ordinary income tax brackets are at the same income level. There is a 20% capital gains rate, again, for higher earners. So it can get as high as 20%. But again, those high earners on the left side of the board, they're paying up 35, 37%. Getting 20% sounds like a deal to them. I will just mention there's another tax, a net investment income tax. I don't want to get too far into those weeds today, but there is a potential to pay a little bit more than these 15 and 20%. But we've talked about that on a different show. But I want to sort of talk about a case study where I had someone I was working with. They came in and they got some advice to sell some of their investments that were in taxable brokerage accounts, so not an IRA or Roth IRA. That's what is subject to the capital gains rates. And they looked at this, say, "Oh, don't worry about it. The capital gains, how much gain there is on that position, is under the 94,000. It was a married couple. You don't have to pay any capital gains rates." Which, if you just looked at this chart and you thought that this 94,000 was just the capital gains, that I can understand how you might end up there. But what they missed is this number, this 94,000, is your capital gains plus your other income. And so I'll show you an example in a second, but you have to add back in sort of your other income, W-2 income from working, other IRA distributions, if you're on Social Security, all of that income gets added back to the capital gains number to determine which capital gains bracket you're in. And a lot of people miss that. And a lot of people do things thinking that they're not going to have to pay any capital gains. They file their taxes in April and they have to pay some tax back because they didn't know how that worked. And so I want to bring up I've done this on previous shows before, but this Excel file where I can just really illustrate sort of real time how these capital gains brackets work. And so right now I have a couple, both 68. The ages aren't hugely important for the example, but in this example, they're both 68. It's a married couple. We're only focusing on federal taxes for right now. State taxes vary from state to state, so I'd have to make a video for every state. So that is not what we're talking about today. So just federal taxes. And our base starting point is a couple, they have $50,000, and I'll show you here, IRA distributions of $50,000. We go to the 1040. This is how they calculate how much federal tax they'd have to pay. That number is 1,773. I want you to pay attention to that number and sort of keep that in mind. So their income is $50,000 of IRA distributions. That's their only income. Tax rate, the taxes, federal taxes of 1,773. I'm going to now go, and they're going to have sold some stocks. They have stocks that's appreciated. They're selling it. They're raising capital gains. They haven't started Social Security yet. And so let's say they sell a position. The proceeds is $100,000. And their basis, what they paid for that stock, was $25,000. So they originally bought it for $25,000. They sold it for $100,000. Their capital gain is $75,000. That gets brought back to the 1040, and I'll show you that here in a second. You have $50,000 of IRA distributions, $75,000 of capital gains. Those numbers get added together to $125,000. You do get to take the standard deduction of $32,300 for this couple. So their total taxable income is $92,700. You say, man, that's increased a lot from the $50,000. What you will notice, that tax rate has not changed. The federal taxes they pay is still $1,773. So they sold $100,000 worth of stock with a $75,000 gain on that sale, and they did not pay any capital gains tax rate. And that's because this taxable income number is lower than the threshold of the $94,900 that was on the board. Just to illustrate that point, I'll do a similar example. Let's say they had $100,000 worth of capital gains. And so same deal, 50,000 IRA distributions, but now they have 100,000 of capital gains. You'll notice this 117 is higher than the 94, and now their tax is 5321. So, I mean, I could go through so many different iterations of this, and we'd spend all day on it. But that just is to illustrate how that works. If you're a single person, these numbers, you're just using the single rates on that chart, so they're a little bit lower thresholds. But that is how they calculate the capital gains. And a lot of people fundamentally do not understand that. And it's important to do that when you're doing proper planning.
Yeah, so we've been up here in the capital gains, but in qualified dividends and the rates and the lower rates and the 0% bracket. But what we'd like you to understand with this is the tax that's calculated first. You know, as an example, we have the people that have $50,000 of ordinary income. So we start here, and that couple would have been somewhere in the 12% bracket, and part of their money would be on the 10% bracket. But then when you add the capital gains, you would take the 50,000 and put it together with the amount of the capital gain. So it just, sometimes people can look at this, and you got from his example where this person, I think it was their son, went and sold some stock without telling them and made a gain. And he said, oh, well, you don't need to worry about that because you're not going to have to pay any taxes because it's less than the 94,000. What he didn't realize is that gets put on top of this, and this couple had a pretty high income, so it wasn't a good outcome. So we want to spend a little bit of time now over here in the ordinary income brackets, and this is frankly what most people are interested in. And you can see that people that are under $100,000 for couples, and for individuals, you're staying in what are now some fairly low tax brackets or taxable amounts. And this is, a lot of this is due to the Tax Cuts and Jobs Act. These numbers are changing unless they do something in 2026. So we got several other videos about that. I just wanted to spend a little time showing the married numbers. And then for single people, they're pretty much half as much, the brackets. In other words, you get into these higher tax rates sooner. And we're going over and over and over and over this because we're not so much worried about 2024. I mean, that's one thing we're concerned about is just building the year in which your taxes are going to be at the end of the year, and we're withholding to that. We're thinking about decisions that you can make now and in the next few years that are going to affect your taxes or effectively lower your taxes for the long term. I mean, it's just as people get older and older and older, if they're fortunate enough to grow old, they um, you don't want tax problems and high tax rates to be hitting you when you're in your late 70s and 80s and 90s and that sort of thing. So we're planning and we're using these numbers to help people make good decisions now prospectively. Now, one of the key points, and I want to bring Tom back on for an example, is the big misunderstanding with this is the difference between your marginal rate and your effective tax rate. And so the example that Tom's going to give is a couple that's right at $200,000 a year. And a mistaken assumption of a lot of people is that if they made $200,000, that they're going to pay 22% taxes, or that'd be $44,000 of income, federal income tax. And that's not how it works. Their effective tax rate is what percentage do they pay on all their income? Their marginal tax rate is the last dollars they earn are the 22%. So I want to bring Tom back on, and I want Tom to go through on that tax return thing an example, just like we talked about.
Yeah, so let me bring up this Excel file again where we're looking at the different options. Again, I've simplified it. Again, the same couple, so I'm looking at a married couple. They're both 68, so that standard deduction comes into play a little bit. And they just withdrew $200,000 of IRA distributions. That's the only income they have. And like Hans was saying, a lot of people will look at that tax form, those rates, and say, okay, I pay 22%. Here's how much I should pay. What they miss is you actually get to fill up those lower brackets first. So some money is taxed at 10%, some taxed at 12%, some is taxed at 22%. But when you add all that together, their total tax they pay is $27,000 in federal income taxes, which that's 13.5% of $200,000. So their effective rate is lower than their marginal rate. The next dollar they earned, they would owe 22% on, but a lot of people assume that all their money gets taxed at that 22%, which is not how the tax brackets work. And so, again, that is something that a lot of people miss. People misunderstand. You know, if someone ever tells you, I don't want to get a raise, it's going to push me into a next tax bracket, that just tells me they don't fundamentally understand how tax brackets work. You are always going to be better off earning more money. That next dollar you earn will always net you more than you had previously. So don't ever turn down a raise. Don't ever turn down extra money because you think it's going to put you in a higher tax bracket.
Yeah, and so Tom, so 44,000 was their, if they used their marginal rate to do their effective rate, but then it was their effective amount was 27,000. What percentage is that?
That's 13.5% of 200,000.
13.5% is what they actually paid on the 200,000. And a big part of that is because of the standard deduction. Because this came in with the Tax Cuts and Jobs Act starting in 2018, and then these have been adjusted for inflation. But a couple, both over 65, they get to deduct 32,300 off their tax return before they even get started. And it doesn't matter how much money they make. And for a single that over 65, that's 16,550. So, we have a lot of clients that come into us and they're telling us about they're keeping track of their charitable deductions, which is probably smart to do anyhow, but they're turning them into their accountant. And a lot of accountants just accept those, full well knowing they're not getting anywhere near these numbers. They don't have home mortgage interest, and that's limited to $10,000 now, anyhow. So by the time you put all of this stuff together, actually, that's not what's limited to 10,000. What's limited to 10,000 is the state income tax, but the mortgage is limited to 750,000 mortgage. And by the time you put it all together, most people are using this standard deduction, and that's what Tom used in the example. So, and now we want to talk a little bit about trust tax rates. And people say, well, I don't have a trust. This doesn't apply to me. Well, you're right. It doesn't. So, and sometimes we just skip over these and we don't really talk about them. But what I really want to point out, just generally speaking, is they have 10% tax rate. And as soon as you get to 3,100, the trust does, of income, it jumps to 24. And then at 15, it jumps to 35. So you have low thresholds for the brackets, and then you jump into the high percentage a trust does very quickly. And you say, well, why is that? Well, part of the reason could be that, that they're thinking anybody that's rich enough to have a trust, we're going to really give it to them. Okay. Now, if you set up a trust and it's a revocable trust, a revocable living trust, which many of you have done, this stuff doesn't apply while you're alive because you're taxed at your ordinary income. It's just like you have that money yourself if they put in your Social Security numbers. So we're not talking about revocable trusts here. We're talking about irrevocable trusts. And then even among a irrevocable trust, if an irrevocable trust distributes the income to the beneficiaries, then the beneficiaries are taxed at ordinary income tax rates. So this is where a trust is accumulating the income. You say, well, where does that happen? Well, there's some trusts that's what they do, is that certain things got to happen before they pay out money to the beneficiaries. And then in special needs trusts is where we run into a lot of this in our business, where they really can't pay out the income to the beneficiary, because that's the whole reason of having the special needs trust, is you accumulate the money in the trust and then you just pay for things for this adult child has special needs. The trustee just does that. They don't actually give the money. So these special needs trusts are actually paying taxes at these trust tax rates. And once we show these to people, we certainly want to try to avoid putting IRA money or something other than Roth IRA money into these trusts. I mean, sometimes we have to. And there's ways to deal with that. So what I want you to get out of the trust tax rates is that they have low brackets and they get into the high rates very quickly. Now I'd like to bring Tom back on and we'll talk about comprehensive financial planning. We have every box checked out here. I mean, your taxes on Social Security are partially taxed. You got IRMA with Medicare, so you're going to be paying income tax if you have a high income. Long-term care has tax implications. 401k IRAs are all infested with taxes unless they're Roths. Income, well, this is the income tax. Estates have taxes. And then this whole subject of this video is taxes. So with that, I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.